Good morning and welcome to this Wednesday, December 7th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we have seen our major moving averages move back beneath the 20-day moving average. So that was step one for the bears to take out the initial support. I do think we have a couple of other key support levels we'll need to watch here before things completely revert back to the bears, but we do have futures down again this morning. The Dow futures currently down 58, S&P 500 futures down 15, NASDAQ futures down 77. So on a percentage basis, we are seeing the NASDAQ hit a little bit harder. Currently, crude oil prices up about 50 cents a barrel. That takes us up back near $75 a barrel, but crude oil continuing to hover near its lows of 2022. U.S. 10-year Treasury yield down 4 basis points, currently at 3.477%. So down very close to that 3.48% area. Find it interesting. A lot of folks still pouring into Treasuries. That is normally not what you would do if you're worried about inflation. There's no reason in the world to be jumping into a 10-year Treasury yield at 3.48% if you believe inflation is going to be a long-term issue. So I think at this point, the bond market's telling us the economy is definitely the bigger issue, not inflation. And that should help the Fed kind of move from its more hawkish stance to a more dovish one over time. I think we've seen a little bit of those hints already being laid. So I do think we're going to see the Fed. I've said it all along. I believe we're going to see the Fed cutting rates later in 2023, not raising them. But we'll see. We've got a big meeting coming up, Fed meeting in another week or so. It starts next Tuesday, ends on Wednesday. We'll get the latest policy statement. And the decision right now, all signs are still pointing to another rate hike, probably 50 basis points. But I think the market will be much, much more concerned with where we go after that. So what does the Fed say? What does Chief Powell talk about? Is he, indicating that they're willing to cut rates? Are they going to slowly cut the hikes? So in other words, instead of doing 75 basis points or 50, maybe go back to doing 25 short term until they get more evidence. I would expect that that's going to kind of be their language. That's been the consistent theme with the Fed, is that they want a series. They want continuing information coming out that suggests inflation is slowing and that that's no longer a problem. So I think they're going to be hawkish, but I think they're going to begin to maybe just moderate that hawkishness just a bit. And eventually, I think we turn dovish at the Fed, and I think that is going to give the stock market a green light. I know a lot of folks are worried, well, what about the recession? Well, I mean, technically, we had 2 quarters of negative GDP. When I think of recession, if our GDP is coming down, that's contraction. That, to me, means recession. Now, the government, has decided that, hey, we'll tell you when it's a recession. Pay no attention to the man behind the curtain. That's essentially what they're saying when you look at GDP and all these things. We'll let you know. Well, by the time they let us know, the stock market will have already, the stock market would have bottomed, and we will be heading back up. And then the Fed or the government's going to say, yep, it was a recession, or we're in a recession. At that point, it's going to be way too late to worry about selling. So I continue just to monitor the charts. And I think the market goes higher. Whether or not we do it this month or next month, I don't know. But I do know that when rates come down, valuations go up. And so we'll see what happens there. Okay. Real quick, let me go over to our website over at earningsbeats.com. For those of you that are new to the show, welcome. We certainly appreciate you tuning in. If you like the show, we're here at Earnings Beats on Mondays and Wednesdays from 9 a.m. to 9:30 or thereabouts. Sometimes I'll run a little bit over. And then over at Stock Charts, you can also listen in on Tuesday and Thursday at 9 a.m. Just click on the Stock Charts TV. I'll show you later in the show how you can do that. Love to have you join our Earnings Beats Digest newsletter. If you have not already, it's a 3 times a week newsletter, usually published around 8:30, a very, very simple read, 2 paragraphs and a chart normally. So if you're interested in technical analysis or seasonality or any of those things, I think you're going to find the newsletter to be very helpful. It's completely free, no credit card required. You can unsubscribe at any time, but please check that out. Those of you that are on the Earnings Beats Digest newsletter will be getting an invitation to our Market Vision 2023 event, which will be held on Saturday, January 7th, 2023. That's coming up 1 month from today. 1 month from today. Hard to believe we've got another Market Vision event coming up, but mark your calendars, and more importantly, make sure you're on the EB Digest so you don't miss an invitation to that free event. It should be a lot of fun. And, you know, we got kind of like a fork in the road here. Got a lot of folks thinking we're going to roll back over and go a lot lower. Got other folks like me who believe we're probably going to go higher. And I reserve the right to change my mind between now and January 7th, depending on the price action and what's happening and what the Fed says. And there's a whole lot of different things that we have to take into account. But anyway, make sure you are signed up for that EB Digest. All right, let's move on to the action from Tuesday. Dow Jones Industrial Average down 350 points. We did lose that rising 20-day moving average, and we did so with a slight negative divergence. PPO has been rolling over while prices have been trying to move higher. We also got right up to a key resistance level. We went just a little bit above. I think we closed 2 days above the August high and then turned around and came right back down. So in my opinion, it's just another key resistance point that we'll need to watch going forward. But in the meantime, dropping back below that 20-day moving average with a slight negative divergence definitely adds a little bit more flavor to this move for the bears, because typically when that happens, we tend to see 50-day moving average tests. So I'm not going to sugarcoat this. That was not a good move yesterday in the short term. Don't like to see the Dow breaking down. What we want to see is a quick reversal and get back up above the 20, not just on the Dow, but across all of the major indices. And with futures pointing down at the open, obviously it's not going to be an easy thing. Going to have a lot of technical traders who are going to be looking to sell today after the breakdown yesterday. So it's going to take some buyers and probably going to take help from the market makers to get price action back above the 20-day. S&P 500 down 57, also breaking below its 20-day. And after barely closing below 4,000 on Monday, we now see a much, much bigger decline take us way below that 4,000 level, down to 39.41. So S&P 500, from a technical perspective, also not in a great position today, below the 20-day. The NASDAQ down full 2 percentage points yesterday, 225 points, back down near 11,000. That's been an area where we have had recent support over the last 3-4 weeks. If you look back here in the latter part of November, many tests right at 11,000 or slightly below. Here we are again, 50-day moving average at 10,913. We're only 100 points away, 1% on the NASDAQ away from what I would say is at least a short-term price breakdown. We do still have the gap support from November 10th. That was the day the October CPI came out, and we had the huge gap up. That gap has not been tested yet, the top of that gap. So that, I believe, was 10,850, if I'm not mistaken. Maybe we'll try and look at that in just a little bit. The mid caps fell 1.1%. That was 27 points. Also well below the 20-day moving average now, not far above the 50. And we've got that gap support from November 10th that we need to watch. Small caps, you know, you can see this was across the board. Small caps down about 1% on Tuesday, falling 11 points just below the 1,200 level. Again, that's where we saw some recent support. That's also where we saw prior resistance, right near that 1,200 level. So kind of like the S&P and 4,000, it's been similar recently on the S&P 600 small cap index, with that 1,200 level being a key pivot area on the chart. Sectors, the only sector up yesterday was utilities. 10 of the 11 sectors were down. Utilities were able to go against the grain, rising about 0.6%. But weakness was among some of the more aggressive areas. Communication services down 2.89% or 2.88%. Technology down 2.14%. Discretionary down more than 1.5%. Throw in energy with falling crude oil prices, and that was down 2.6%. Now down to that 85 area where we had seen these recent breakouts. I'm going to call it 84, 85. That was a prior resistance that now becomes support. And remember when we were up near 95 and I talked about that PPO rolling over, showing a negative divergence as we went up to new highs, and how the 50-day can be a magnet after a negative divergence print. Same thing, by the way, if you're trending down and you get a positive divergence where price action keeps going lower, but the PPO starts to turn up, then you could be looking for a 50-period test in the other direction. XLC was a perfect example. Lower prices, higher PPO, went back up, 50-period test. So you got to look at this from both sides. All it is just one more indicator, and it's a secondary indicator. When I look at divergences, it's not my primary. I'm still looking at price action. But when you start to lose some key areas of support, like the rising 20-day, that starts to make those negative divergences a little bit more important, which is why, again, I would go back to the Dow and just say, hey, negative divergence, rolling over, closing below the 20-day, short term, that could be trouble. If we can't get back up through that 20-day moving average, I think the 50-day becomes the magnet to the downside. But having these three aggressive groups underperforming again yesterday, of course, on a move to the downside, we expect that, but we're in a downtrend. We're trying to get these three groups to right themselves. So I don't like it any day that they're underperforming. They were starting to show some strength. You can see discretionary has rolled back over. We have some support right around this 138, 139 level. And if we can't hold that, I mean, really the recent lows come into play. And if the discretionary stocks go back to their recent lows, I can't really see in a scenario where the stock market does well. So that's going to be a key area to watch. Does discretionary break back down again? And as far as the XLY goes, right now, Amazon and Tesla are both under a lot of pressure, and those are the two largest holdings in the XLY. So this isn't rocket science. If the XLY is to turn around, we've got to see some good action from Amazon and Tesla. Now, for those of you who like to look at patterns, let me just point out right now that Tesla, obviously in a downtrend, failing at the 20-day, not looking very good. However, we do have this low coming down all the way to these lows. You can see the PPO has never gone back to a new low. So we do have a positive divergence, which suggests a potential 50-day test to the upside. But we've got to get through and sustain a move through the 20-day. That's point number one. Number two, I see a potential bottoming head and shoulder pattern, but it doesn't execute until you get the breakout. So here is the move to the downside. There's your left shoulder. There's your left side of the neckline around 200. There's the lower low to form the head. Back up to 200 for the right side of the neckline, and then right back down to where we were on the left shoulder. This is a fairly symmetrical head and shoulder, bottoming head and shoulder pattern, but it doesn't mean anything until we actually get the breakout. To the downside, if we lose the low from back in November, then this is all for naught. The pattern is disintegrated. It's gone. No more worrying about whether or not we have a head and shoulder pattern at the bottom. So that'll be worth watching, because again, this ties into the XLY. It's a big component. It's over 20% of the XLY. If Tesla fails, chances are that XLY is not going higher. So that's why I think this is an important chart to be watching, because then that feeds into the XLY. And if the XLY is not performing well, again, it's hard to imagine the S&P 500 going higher. So I think Tesla is one of the key stocks to be watching here, whether or not we can hold this right shoulder, hold the, make sure we don't go back down below the head, and eventually break out above 200. Will we do it? Don't know. We're going to find out. 10-year Treasury yield today. Let me give you the latest. So we're now down to 3.46, 3.459, breaking down below this support area. I'll tell you what, when we were going up in the 10-year Treasury yield, the NASDAQ really struggled. Now we're coming down, and right now we're not really seeing a lot of strength in the NASDAQ. So when I see that kind of bifurcation where the bond market is telling me one thing, this to me is bullish. Because if we're coming back down, it's telling us that our battle with inflation is nearing an end. That's good. That's really good for the stock market. But at the same time, the bond market is sending me that signal. The stock market, I'm seeing a lot of my sustainability ratios roll back over. We're seeing some key support levels fail, the rising 20-day moving average being one of the key examples. And so the stock market is starting to show more bearish signs, while the 10-year Treasury yield and the Treasury yields in general are painting a much more bullish picture for the stock market. Now, when I see that kind of bifurcation, those two different animals, I tend to believe the bond market. I've always said the bond market to me is smarter than the stock market. I think the stock market gets manipulated a lot more. Personally, that's just my opinion. And so I really like to pay attention to the signals that the bond market is sending me. But I don't want to ignore the technical signs that we're seeing on the major indices. So the S&P 500 failing to hold the 20-day. I said yesterday to our members at Earnings Beats, I pick my spots when I want to use leveraged ETFs. I don't like to buy and just hold leveraged ETFs because as you go through the constant up and down, prices erode on these leveraged ETFs. And I can give you an example. First, let's go over and look at the NASDAQ 100. So do you see, of course, yesterday we broke below the 20-day moving average, but the day before we were just a little bit above it. I'm going to shorten this chart just so you can see what I'm talking about here. So this is just a 3-month daily chart. But do you see how on Monday we closed well above the 20-day moving average? If you look at something like the TQQQ, this is an ETF that tracks the NASDAQ 100 at a 3-to-1 clip. Now, if you look at this, I want to point out a couple of things. Notice on Monday, the TQQQ was down at its 20-day moving average. Again, if we look at the NDX, we were well above the 20-day moving average. Again, it's the erosion. Do you see the NASDAQ closing above? It had a higher candle body on December 1st than it did back on November 15th. See that right there versus this right here? We broke out. Let's go back to that TQQQ. We actually closed right on the same level. So again, over time, the up and down, the up and down, the up and down erodes the performance of the TQQ. Now, that doesn't mean that when the NASDAQ ends up going up over a long period, the TQQ won't go up as much as the NASDAQ. Of course it will. But you might not get that triple that you're looking for. And that's where I think, you've got to be careful because you're taking a lot more risk and you're not getting the return that you thought you were going to be getting. Now, these leveraged ETFs, when the market goes up, you could probably go back and do a calculation. I'm not going to do it today, but here from this close of 1921, 3 days later on October 25th, we were at 2255. I'm guessing that these 3 days, the TQQQ went up more than 3 times the NASDAQ 100 because there's a compounding effect. The best time to be in these leveraged ETFs is when you can catch a bottom and ride a trend for a period of time. So again, I'm not going to do the calculation here and waste everybody's time, but if we go back and we look at the NDX over that same period, which was right here, and if we went from that close, 11,046.71 to this close, 11,669, calculate that percentage and do it on, if you wanted to just test it out. But go back and calculate what the NDX did over those 3 days, and then calculate what the TQQQ was over those same 3 days and see if it wasn't more than 3-1. I believe it probably will be. Anyhow, that's the point I'm trying to make. We want to catch these leveraged ETFs when we believe that we could be bottoming and then starting another uptrend. Well, if you know much about the stock market, you know that typically when we make breakouts and we come back and we test the 20-day, that's where we normally bounce. Here, this was went just a little bit below the 20-day and then a quick bounce back up. Here we went a little bit below the 20-day, but we haven't lost key support. And so the first thing I would say here is there is a key closing level or opening. We have not closed or opened below 11,549.69 over the last month, or maybe just a little less than a month, 3.5, 4 weeks. Then comes the major gap support level from November 10th. That's when the October CPI came out. Was much tamer than expected. You remember that pre-market? I mean, the market was just going up as fast as I've seen it in pre-market. And so we went from 10.8 to 11,350. We were up probably 4% at the open the next day on the NASDAQ. And look at the volume that came in. So right there, we opened there, we went down a little bit and then broke back up through that level. And that leaves that support level as a major support level on this chart. I am not going to be nearly as bullish in the short term if the NASDAQ goes back and loses that gap support. So that is going to be one to watch very, very closely. If I pull up that is 11,350 on the NASDAQ 100. 11,350. Keep that number in mind because we're only 200 points away. We were down 237 yesterday. We were down a couple hundred the day before. We go down another 200 and we will be at, if not below, this 11,350 level. All right, let's move on. So I've been doing this top stocks, our EB top stock segment last couple of days. I'm going to keep doing that. Just pointing out some of the stocks that have really been performing well. Yesterday, Vivint Smart Home had a huge day, up 32%. NRG Energy agreed to buy Vivint for $2.8 billion. And the fact that it opened, closed, and traded in a very small range, I didn't see the details, but this looks to me like a cash offer. Normally, if it's a stock offer where VVNT shareholders are getting shares of NRG Energy, then normally it will fluctuate based on whatever NRG Energy is doing. In this case, it didn't really do much of anything, which tells me that it was a cash offer. Again, I haven't seen it, but that's based on, my background in public accounting and just experience looking at these charts. When you don't see much movement like that on massive volume, it's pretty much a done deal at that price. So let's pass on that one because it isn't going to be trading off of that price level going forward, or it shouldn't unless the deal falls through. Sumo Logic, this is one that was breaking out intraday, and this would have been a key neckline breakout right here. Left shoulder over here, right shoulder over here. Intraday, we were making a big breakout. Excuse me. But we failed. And anytime we get that failure like that and we do it on big volume, it makes me really nervous. We've been in the stock that's been downtrending, sideways consolidating for a while. We need to get that breakout above about 825 or 830. We had it on big volume yesterday, and then the carpet was pulled out from under the bulls and we came back down. Again, that to me is a more bearish signal. I would be bearish the stock until we can get that confirmed breakout above 8.25. And then we've got other levels to deal with, but that's the initial one. We got to get through 8.25. So I'm not really interested there. GTLB, this is one that reported earnings yesterday. I suggested on my show yesterday, it looked like it was going to gap up near the 50-day moving average. And I said, I wouldn't trust this move to the upside. I wouldn't be surprised if it sold off. Well, it gapped up, got almost right up to the 50-day, and you can see the big reversal. It actually came down more than 10% from its high intraday, and then did rally back up a little bit. but it's got trend line resistance to deal with. It had huge volume and it closed below the open. So we had a filled candle. I don't know. This one just doesn't look very good to me. Until we get that breakout above the 50-day moving average, I'd be careful. Those were from the strong earnings chart list. From our strong future earnings chart list, here were a couple. LEGN making a nice breakout here above this recent high. That looks good to me. I wouldn't be surprised to see a run now for 57.5 to 58. MLCO, Melco Resorts and Entertainment. This thing's been on a roll. It's just too overbought. I love what's going on here. Great volume trends, AD line. Everything looks great. It's just so overbought that it's hard to take a position. But this is one that if and when it begins to slow down, we could see an easy 15-20% drop, maybe back to test that 20-day moving average. That's when I'd be more interested in MLCO. TXT, this is Textron, another one that gapped up above resistance. It did print a filled candle, but it still closed above this congestion here. So now I'd be looking maybe at 71.50 to 72 as key short-term support, along with that rising 20-day moving average. I think as long as the stock trades above the 20-day, I like it. On our strong accumulation distribution chart list, RYI was the #1 stock. It is now trending above its 20-day moving average. Short term, I like that. Not a lot of volume. It's got some overhead resistance coming up at 34. So I think it's probably a do nothing at this point. Closer it is to its 20-day moving average, it could be a trade with a tight stop. YEXT, this is Yext. Huge move here back on the 1st of December. I love this candlestick. After a long trend like this to the downside, it started to strengthen a little bit. The AD line is up near a 52-week high, and I love that. That's close to a Marubozu candle where you open on the low and close on the high. We didn't quite do that, but that's a pretty solid hollow candle on nice volume. So the biggest support level to me on a stock like this is the opening price on the gap. So for Yext, for me, the opening price was $564. That's what I would be watching for there. On our raised guidance chart list, these are stocks that have recently raised guidance within the last few months. And one of the stocks, or the leader in this group, was CFLT. Obviously, the raised guidance hasn't been doing a whole lot to influence a lot of buying. Stock continues in its downtrend, and even though yesterday was up almost 3.6%, it remains in a downtrend. I really don't see anything here to like much. SMCI, this is Super Micro. This actually, I do like that reversal at the 20-day moving average. I wouldn't be surprised to see this one, have another run back up for about $94, $95. That would be a 10% move from here. If we were to go back and take out that low from yesterday, then I would think maybe this gap support at 75 would probably come into play. All right, earnings. I'm going to just show you a couple of companies that had some really big reactions to their earnings. The big one was MongoDB. This is a software company, had been trending down, really not showing any signs of anything good. Well, they were expected to lose 17 cents in their latest quarter. They had a profit of 23 cents. Huge turnaround. Obviously, they weren't sharing that news with Wall Street ahead of time because the stock was not performing well. But if we look at the pre-market action, we will see stock up 27.83%, $40 to $184, up near this prior high. My guess is that, again, because we're right at this resistance level, I wouldn't be surprised to see some short-term selling on MDB after the opening bell. We'll see. Let's see. We'll look at two more and then we'll wrap up. These will be the three you must see as well. HQY. HQY reported numbers that beat on the bottom line, 38 cents versus 35 cents. But you can see the stock is down 2%. It was kind of in a bear flag, moving down and then kind of coming back up, or maybe you call this a wedge, whatever you want to call it. But doesn't really look very good to me. And the fact that we're now gapping down with earnings, I wouldn't be surprised to see this begin to roll back over again. And then the last one I will bring up is, let's see, how about Mobileye, MBLY, which was seeing a pretty good reaction to its earnings. They were expected to post 13 cents in earnings. They posted 15 cents. Stock has been trending up for the last month and a half since it went public, and it is up another 6.5% today to 32.50. I'm going to pull this one up and look at the candle because it looks like it's going to open very close to the key level, which was 32.43. I'm trying to see if we get an open here. There it is. Today's open is at 32.43. So it is opening right on key resistance. My guess is that it will not make the breakout based on the fact we didn't open above. It's kind of strange for a stock to open exactly on resistance at 32.43, but we will see what happens. Kind of watching it here. It comes back down now, 32.07. We'll see whether or not we can get back through. A close with big volume over 32.43 would be bullish, but my guess is the probability suggests maybe we're going to go down first, maybe at least a gap support, which would get rid of that $1.58 gain that we've got going on right now. And then we'll see what happens from gap support. And that'll probably make that'll probably end up making a call for the longer term. All right, let's move on over to the dashboard, see what's going on. Right now, well, things have gotten better than they were in pre-market. I know at one point the NASDAQ was down 100. The futures were down 100. Now we're down 36. Dow down 48. S&P down 7. I'm also kind of keeping an eye on the VIX. The VIX is moving up, but it really isn't up a lot considering that the market is now back down below key moving averages. We've seen a few days of selling. I mean, it seemed like, back throughout the year, we'd have the VIX up near 30 at this point. And now we're sitting at 22. So the VIX tells us a little bit about the expected volatility going forward. That's what the VIX does. And so when the VIX is not moving up where we would think it's telling me the fear and the panic and the volatility ahead, all of that, the expectations are all coming down. And that's bullish as well. So I'm still seeing a lot of signs that tell me this move to the downside is not going to last. But at the same time, you can't ignore it. When you go below the 20-day, in my mind, you have to get a little bit more cautious, whatever that means to you. When we get back up above the 20-day, I think that kind of changes the picture again. But let's see what happens today and whether or not we accelerate to the downside, or because we did gap down, do we actually put in some sort of reversing candle, a bullish engulfing candle? That would be incredibly bullish after going just below the 20-day. So all of those things, I think we need to be paying attention to as we go throughout today's action or see today's action. Anyway, that's it for me. Again, appreciate everybody tuning in. I'll be back tomorrow. This is where you can catch me on Tuesdays and Thursdays. Stock Charts TV, just click on that at 9 a.m. and it'll bring you right in. And you don't need to be a member over at Stock Charts to listen in. Listen, everybody have a great day. Be careful out there. Let's see if we get a reversal. And we'll go back over everything again tomorrow morning. Happy trading, everybody.